All right. Good evening, guys. This is the weekend Foundations Q&A session for May 22nd, 2021. Let's go ahead and get started. So Zoran asks, is Zoran on tonight? Yep. How do we Foundations folks get to the point of joining the strategy podcast? So I call it a podcast, but it's just another go-to webinar meeting that I do nightly at 8 p.m. Central. Let's see here, just a second. And if you can listen in as I'm doing that live, but it's the same as another GoToWebinar session, and then I just produce the recording as a podcast. I want to show you where I'm doing that. So stand by just a second. This one that has the list of all the May sessions 2021, May 2021, and then the registration link is up here. So if you go back and look for all of the indexes, you'll find all of the previous monthly links. And then you'll see that I am basically doing on Monday night through Thursday nights, I'm doing a, let's see, let me put it this way. Yeah, Mondays through Thursdays, I just do the regular daily report review. And then Fridays, I do the weekend report review. And I might put a bonus in there sometimes when there's a good lesson or whatever and I want to extract. And then Saturdays, I do the Q&A session here for Foundations at 6. And then Saturday is in a couple hours, I will do the swing frame review. And then Sunday night is the day trade frame review. So that is the ritual of the reports. Later, if we start doing the structured day and swing trading, what I will do on that is a day trade Q&A and then a swing trade Q&A, and I may just put all of that into a hybrid trading Q&A and maybe just do them all at once so that I do foundations, then day, then swing, then hybrid, all in one series for efficiency of time. And I'll probably do those on a Saturday. So that's sort of the straightforward element there. And then there are some times when if I'm doing a special that I want to just highlight to you, I'll put in a note like includes a 3-day speed run or hey, very good discussion of exit management or improving decision makings and so forth. As you go through those, you should, anytime you see where it says bar by bar, you want to note that one as a good training session where we went, deep dive on some trading case studies, and there's probably 100 of them from November onward. They're so well done. I really think that's probably its own workshop. Somebody sent me the links to all those, and I just have to assemble that into one page so that they're all concisely on one spot. But until I do that, if you just scan through the indexes, you can see that. Okay. So yeah, the way you get to that is, by being logged into the or registered as a subscriber on Patreon, so that you can get the daily messages and all those links and so forth. I can't do guest accounts. Patreon only allows people to be paying subscribers, so the minimum that I can charge you on that is $2. So I created the dojo $2 for the folks that are already, have already paid for a workshop, and that's kind of the cost of doing business right there for $2. Then later, after the the scheduled workshop level is over, you can then pick a level of subscription support that gives you what you want. Like if you just want the reports and don't need any of the other stuff, I think it's $25 a month. and then it scales up from there if you want to stay connected to the different courses and the ongoing materials. Okay. All right, next one. Zoran asks, I'm walking through the settings, and the PSAR uses the RL10 as the calculator. Yes, that's correct. In fact, what that actually is doing is that the PSAR indicator, why is it not giving me my standby? My pen was frozen. Let's try that again. Hey, there we go. Yeah, so the PSAR uses some price value. It uses some number. The traditional way of doing that is price. But what I use is the RL10 value to compute value. The RL10 value to compute the PSAR. Right. So one of the things that you'll notice is that when you do that, you see, prices going down, and then starts to go back up. You'll get like a if that was, in the winter time, that RL10 would probably look something like this, and then turn into spring and do that. And then you would see the PSAR dots, coming down like this, and then at some point it would roll over, probably right about there, and then start to roll back up. Well, that PSAR comes, it anchors to the extreme of the RL10 because math. All right, and what that does is, if we were to zoom in on this, we would see that on the last bar, the absolute extreme level of the low was there, but where the RL10 probably turns, it looks like this. This becomes the statistically significant support level. Okay. And so now when later on, if price is now moving down and it clicks, when it violates this, then check, we have a downward move. And that allows us really to get inside the trade and to make entries in here on the downside, instead of waiting for the absolute breakdown of the lowest, because that could be one person made that little entry, but this is where the statistical significant price reversal happened. That was where the support level. So when that one breaks, then, there is a psychological element that on the way down, what was the price that triggered guys to come in? It was this price. And then now all the buying pressure comes in, and then it takes that much price action to actually reverse it and send it back up. But the decision was made at this price level. So when we are when we have a box that's going up, and we're going to have some kind of risk box in here, so we're going to take a risk box right there, and we're going to get our entry right here. That's like an SSC entry. And then we've defined our risk box like this. What we're saying is we're putting a price level in here to get us out that is geared towards the price level that represents the actual support level based on the decision making of the people that are trading it, the buyers and sellers, right? What that gives us, though, is a lot of time. If we're going to do this as a SSC failure, which it will be, and that's going to make it a collapsing dragon because it's collapsing below this level, that collapsing dragon, what that does is it gives us this room in here to enter at the last moment of hesitation. It's hesitating in here until maybe so other people that are using this lower level of price as the place to begin to get short, we're already short inside here. And now when it hits here and starts to really collapse, we're already moving our stop to no lose plus dinner for 2. That little difference makes a big difference when it comes to reducing the amount of slippage and for getting our entry a little bit sooner and moving our stop to no lose plus 2 a little bit sooner. So Zoran asks, do you flip over on the RL10 crossing the PSAR or on the price crossing the PSAR? For me, it's the price. When we're in the SSC, and I talked about this last week or the week before, but the PSAR is cruising down, right? And the dragon, this little wide dragon, is usually lower than that because of math, right? So here's what that looks like in practice. The PSAR is drifting down, the dragon is drifting down, and then price starts to reverse. And I'm going to draw this as the RL10 first. Just a minute. Let me clean this out of the way here, right? So now the price behavior is this kind of action. Give it one more, and then it starts, cruising up like that, right? I wish it was that orderly. It never really is. But so the RL10 is really close to the price because math. It's very adaptive and it finds that critical price, and then it starts to reverse. Now remember, I'm showing this as the RL10, and I'm coloring it red because it's in the winter on MACD, right? So I have it color coded as red because it shows the season, and that tells me that's everything that I want right there. Now remember, we also use that baby dragon which is a simple moving average 3 of the RL10. So it's always going to lag. It's always going to lag that little bit. So the first thing that happens is the RL10 bottoms out and reverses, and then usually very soon it gives you that second alert that it has crossed the baby dragon. And then at some point in here, that RL10 goes into the spring. So I'm going to draw that as orange just so that it's a little bit easier to see, but imagine that is yellow. So it's going to, that RL10 is going to keep going up like that. So what we're now interested in is where does that thing cross the dragon? And then the dragon is going to reverse, right? And then we know that the way the PSAR is constructed, we know that the bottom peak of the RL10 is where that PSAR, whenever it flips, that's going to be where the first PSAR dot is drawn, right? And the actual bottom of that price level that was down here, that final extreme, now that's probably, in my view, that is probably where the amateurs are looking at this and saying, I'm going to put my stop. They're going to put their stops if they're going long in here. Or the guy that wants to add to the position to the downside says, hey, if it makes a new low, then I'm really going to start adding positions. So it's my opinion, my hypothesis, that this price level below the extreme low of price is where there's a bunch of contingency orders that are going to conspire to make this thing go low, to go lower in a great big hurry, right? And so those are all geared off the lowest level of price. So when we are using the RL10 flip as our trigger to exit the SSC, and it's our trigger on the collapsing dragon. So we have two places where I allow you to call it a collapsing dragon. The first one is if it violates below the belly of the dragon. So I'm going to call that red. I'm going to make that red. Or the belly of the RL10. Okay, I will accept either one of those as a collapsing dragon pattern. Now, sometimes the distance between those two is so trivial that it's really the same signal. On rarer occasions, it's a wider observable node. You actually see that sometimes on like on swing trades or daily charts because of gaps. So you might actually see a difference between the belly of the dragon and the belly of the RL10. But I will accept either one of those as a pattern definition of when to enter a collapsing dragon. Well, what that also means is that both of those are legitimate places for you to have your exit on an SSC entry. Because remember, the SSC pattern is looking at this. It's looking at a harsh winter, number one. It's looking at a bottoming out of the RL10. It's looking for a cross of the baby dragon, 3. And now it's looking for the RL10 to turn to spring, that's 4. And then usually right after that, it will turn to, the RL10 will cross the dragon shortly thereafter. That's number 5. And then you can buy the next breakout of that bar at number 6. And then you would use, by design, the initial execution risk would be down here to the belly of the RL10, which also happens to be where the PSAR is going to flip when it flips. It's going to be like right here. And then the RL10, when this thing works, is going to start looking like that, right? So this red box now becomes our execution risk, right? So the finesse on this one for your question is, where do we enter on the SSC? I say the RL10, the RLXD has to cross the dragon, and then you buy the next breakout. But sometimes we notice that price has been moving down, and then it makes these large burst moves. And so sometimes we end up getting according to those rules, we get a late entry up in here. And so we miss a lot of this move in here. So what we have said as a discretionary rule, once you get comfortable with this pattern, is that once we're into the winter and we start seeing these RL10s moving down, I'm willing to take price going through the RL10 as the entry, because that's normally a bar or two faster than the entry that waits for the RL10 to cross and then buying the next breakout. So there's a little bit of finesse on that, and it's something you got to practice. But that's the main idea. So once we get into that winter, what I'm looking for is that when price breaks up through the PSAR, especially if it's a violent move off the bottom, then I normally just say, oh, that's real buying pressure is coming in. So I'm just going to take it at the PSAR. I'll get my stop. Now, when you get it at the PSAR and you say, well, where am I going to draw my box? The PSAR hasn't flipped yet. Well, we know where the PSAR is going to be drawn. It's the bottom of the RL10. So you can just automatically draw your box anchored to the bottom of the RL10, and then it will catch up later. And meanwhile, you're in the position, and you already know at point number 2, when the RL10 reversed in here, when that RL10 reversed inside here, you already know where the PSAR is going to be drawn later. We just don't know where inside that circle, inside this purple circle, we don't know where inside that purple circle price is going to actually hit for us. My opinion now is that as long as we're around the PSAR for an entry, we're not going to be dissatisfied. And what that means conceptually is when you look at enough of these, you will see the PSAR coming down, and then at some point the PSAR will flip and go up. And the way that is tuned to the RL10, which is smooth, you get these long, smooth moves. And what that means is that if we were to just draw this indecision zone between the end of one PSAR and the start of another, this kind of this space between the PSARs represents, in a real way, what our execution risk is, because you're between the PSARs, this one coming down and that one going up. That's what your execution risk is. So in my opinion, on a day trade or a swing trade, and this gets to a question Garen asks in a little bit, if you set that equal to 0.2 R, no matter what, then that just means that once, if you are doing an SSC and it fails all the way back down to here, and then you get a collapsing dragon, you're only looking at a 0.2 position sizing risk. So that's like an ante in cars. Like you just paid your 2 bits and okay, it didn't work. Because the size of the moves in either direction, when it works with an SSC or when it works with a collapsing dragon, it's going to more than pay for any false starts that you get, okay? All right. To complete my thought. So on a day trade, the other thing to think about is, as a rule, is the frog box. Now, the frog box is the difference between signal and noise on the intraday trade, okay? The difference between signal and noise on the intraday trade. And so a lot of times you might see something where the frog box is equal to, it might be equal to $1. And so what that means is intraday, and it's $1, that a move off the bottom, so if it went something like, the RL10 came down here and then started to go back up, any move off the bottom greater than 1 frog box is by definition signal. Oh, let me clean that up. Anything greater than a frog box is the beginning of signal that this is a long side move. Anything shorter than that is noise. It starts, the more it goes up the stack towards that frog box, the more it's looking like signal. Like right here, it's about 0.9 signal and 0.1 noise, right? So when it first makes the turn, you say, oh, was this doji in 1 bar? Was that a signal that it's going to reverse? No, that's about 0.9 noise and 0.1 signal. And up here, by the time it's moved that far up through the frog box, it's about 0.1 noise and 0.9 signal. When it gets above a full frog box, mathematically we say that is, by definition, 100% signal. Well, it turns out that when you're drawing these little wrist boxes over here, like from the RLXD down to the PSAR, that is typically much less than a frog box. So what I want to do is I'm using the frog box for position sizing risk, right? And I'm using whatever the particular pattern happens to engineer as the size of the move as the execution risk, whatever that may be. Now, if the execution risk that you're getting from the chart is also equal to 0.2 of a frog box, then it's no problem. Everything works right. But when we're first starting this, at the start of the day, I would just say, look, if the frog box is $1, and I'm going to risk $400 per trade, my maximum position size is going to be 400 shares, no matter what the size of the execution risk is. That's one way to do it, working from the frog box to the position size. The other way to do it is simply to say, look, I'm going to risk $400 of risk, and then I'm just going to go measure the size of the execution risk, and let's say that was 20 cents. 20 cents is, if that's equal to 0.2, then and it turns out that I'm using a full dollar now as my position sizing risk, and then that gets me to 400 shares. But if that was 50 cents, let me clean that up. But if that execution risk was 50 cents, I'm going to multiply that by 5, and I'm going to use a full $2.50 for position sizing risk. And when I run that up into 400, I'm limited to, why did I do this? So 160 shares. And that way I am ensuring that I don't blow up my account on the basis of having a really small minimum manageable risk box. Now, in this case, if you do it as I'm just going to start with the execution risk. So if I started with the frog box risk, it got me to 400 shares on every trade. If I use the execution risk times 5, it got me, in that case, to 160 shares. Now, what makes that maybe more challenging for you is to say every time that I compute the execution risk, I could be coming up with a different position sizing risk, and that adds more complexity and uncertainty. How big is my so one thing you can do is just accept a standard risk and just say, look, I'm never going to exceed 400 shares because $400 divided by 1.0 frog box turns out to be 400 shares. You could say never violate that to the upside. Then once you get familiarity with your signal on your time frame, you're going to start seeing how big those little execution boxes are. And after you do that 5 or 10 times, you're going to realize, oh, I'm always using 25 cents because that's just the way that thing trades. So I'm going to use 25 cents as my minimum manageable risk box. And sometimes that's wider and sometimes that's narrower than the execution risk. But if I just use 0.25, then I'm just going to use a standard position size of 160. Well, the beauty of that is that you end up using a standard chip size. And so as you start looking at your chip stack and you're just going, hey, I'm going to put one chip on it, and that's always 160 shares, then that simplifies the cognitive complexity of your trading. And because of the 0.2, you're either using the 0.2 factor or using the frog box factor, the amount of risk that represents to your overall portfolio is small enough that you can actually trade this according to the rules as you learn without blowing up. Because here's what will happen otherwise, and I've seen this 100 times. 100 times, Ken? Yeah, I've seen it 100 times with people that aren't trading with us anymore. They're just going to do it their way. Fine. They're all grown people. But one of the long-term principles that we use in the Foundations course is the idea of the minimum manageable risk box. The minimum manageable risk box means how small can I make my execution risk so that if I get long and I'm in and I have my risk down here and this thing starts failing, I can execute down here without taking more than -1 execution risk. So maybe that means your minimum manageable risk box might be, the PSAR plus you give yourself a little cushion for slippage, and then that whole thing is your MMRB, and your execution line might be right there. That's why I like to execute on the belly of the dragon. So if I got an SSC going on, and then that thing starts to roll over, I execute there, but I'm using the bottom of the PSAR as my execution risk. So again, there's a couple ways that you can get into deciding how big your position sizing is. In my view, where you want to get to is a satisfying, for the long term, for the whole week, a standard position size. And I don't care whether you get there from the frog box method or from the pure execution risk times 5 method. As long as I think you get to a standard position size so that you don't have to worry about that, you can just start putting chips on the table. You start putting the risk chips on 1, 2, 3 bullets real quick, and it's always a standard size. You have made this standard work. So that's a long explanation that just gives you what I think are the real options on how to decide what your standard position sizing ought to be. Because where people make a mistake that I have seen is they say, well, my execution risk, if it was 20 cents, I'm just going to use that as my position sizing, they say. Because when this works, it's going to be massively good. Oh, yeah, that's great. So I'm going to risk $400 on a 20-cent risk. That means I can afford 2,000 shares. So now, because I was able to squeeze this into a tight little doji and it was only 20 cents, I can have 2,000 shares. Hey, what if that thing ended in a doji and it was 5 cents and you just said, hey, I'm going to use the doji as my risk. And because that's only 0.05, I'm going to divide 5 cents into 400. And now I have 8,000 shares. Really? Are you going to tell me that you think it's the same trade and that you won't lose your mind if sometimes you're trading that thing on the same pattern with 400 shares on one trade and the next trade you've got 8,000 shares? You're 20 times larger? You're nuts. So what we do is we separate out the execution risk, which simply tells us when that thing fails, and the position sizing risk, which tells me what size position I can afford and maintain my sanity and maintain proper protection of my capital. Because remember, when you're trading with the MMRB, the most important decision you make after the entry is when you go to no lose plus dinner for 2. So I've got things going down, and the dragon has moved down and all that stuff. And then for whatever, I don't care what pattern or what time frame you're looking at, but it's going to look something like this. Price is then going to be moving up. And you've decided that because of the pattern you're using, whether it's swing trade or day trade, 1 minute or 1 month, that you've decided that you're going to enter like right here. And you've decided that your risk box is going to be right here. And you're using the bottom of the dragon. And here's my risk. So when this thing goes up far enough, the next thing that I'm going to do is and here's my entry, right? And here's my risk. The first and most important decision I got to make, my decision, is when I'm going to move that stop to no lose plus dinner for 2. Once I've done that and I've locked in this gain, I'm never going to lose money on that trade. And now this is just a science project. Why? Because the no lose plus dinner for 2 takes my risk. This was the initial risk that I took to my seed capital, my money. Once I can get to no lose plus dinner for 2, my risk is out of there. And now we're just figuring out how much of the market's money am I going to capture. That's all. So when we do that, what we want is the idea of the minimum manageable risk box, so that the smaller I can make this box, the sooner I can move to no lose plus dinner for 2. So what you don't want the size of this diminishing box to drive your position size. You want your position size to be a comfortable distance away from that, because if my position sizing risk is that big box and I was able to get an MMRB down here or an MMRB down here, each time I'm just refining my execution, but I'm not affecting what the definition of 1R is. It has to move this far for a 1R move. And so now the difference between these two is a fraction of the 1R position sizing. So if this was 5 cents and this was 10 cents, I don't want the position size to be twice the size. I want it to be the same standard position size, and then just refine my exit. And that will smooth out your equity curve and prevent you from blowing up. That's as much as I can say on that one now before I listen to your questions. So, Ken, I think that's, reading ahead to your question, I think that's the long kind of involved answer. I mean, I could just tell you what to do, but long term, you're going to ask these questions of yourself. So I want to give you an organized way to think about it. So Zoran asks, hey, Ken, I understand that the amount of risk each one of us takes is a personal decision. You are correct. I would find it useful if you could give an example of a capital management strategy in terms of how much capital to deploy between intraday swing and position. First, over the last 30 years of my trading, right, I had what I would call core, swing, and day trading. And the sum of that was going to be equal to my portfolio, my total meta portfolio, okay, meta portfolio, or my total money. So 30 years ago, this was about 95, 5, and 0. And then this became 80, 15, and 5. And then 70, 25, and 5. And then 60, 30, 10, and then 50, 30, 20, and then 40, 30, 30. And now it is 20, 40, 40. Why? Because my advantage is in this space here between swing trading and day trading, because I can fire and forget these positions with that wide 10% stop, or sometimes tighter if the weekly pattern indicates it, but a 10% stop adjusted weekly or monthly. And it's only 20% of the portfolio, so I don't sweat it, okay? And then on the swing trade, approximately, I'm never going to take more than 2 ATR risk, so I always know how much risk that is. Now, sometimes it's less. Sometimes it's less. Why? Well, because of the pattern, or the risk Z, or the season of the MACD, or the 3-day or 9-day frame, or the bottom of the RL10, but it's never more than 2 ATR, but I will allow it to be less on the basis of patterns and reasons. That's why on the weekend report, when you hear me talking about where I would be placing my stops on SPY on those monthly, 9-day, weekly, and 3-day, that's because a good portion of my core is in a 3x SPY. Because if the market's working, I want to be long the broad market, and if I'm long the broad market, I'm going to be long with efficiency. So I'm actually, vocalizing where I want to be on that position. So on the swing trade, I'm never more than 2 ATRs of position sizing and risk. Hey, what if the execution stop on the pattern happens to be further than 2 ATR? Then I move it up to 2 ATR. On the day trade, because I'm carrying no overnight risk, I always have cash available to do something as a hedge against the swing trade that's open or against the core that's open. And sometimes I just put that hedge on with leverage so that it makes the swing trade overnight market neutral. So I can sleep like a baby. And then the next morning, if everything starts going up, I can take the hedge off, and now the swing trade is working. So I can use the cash the next day to trade turbo off of the core, or off the swing, off of my swing positions. So now the relationship between swing trading and day trading is what I call hybrid trading, is how to balance the relationship between swing trading and day trading. And hybrid trading is also how I balance between core trading and swing trading. So both of those together is hybrid trading across the entire portfolio. And so this 95, 5, and 0 is where I was when I was 30. And 20, 40, 40 is where I am when I'm 63. And 10% overnight risk in the core positions, never more than that, and never more than 2 ATRs on the open swing positions. And that doesn't mean that I'm fully invested on swing trades. But if I'm fully invested, then that's going to represent 40% of my market exposure. And then 40% cash all the time, ready to act on day trading, either as pure day trading or acting as core and turbo as part of a swing trade, which is what I would prefer to do because I'm already managing the swing trade. And if that swing trade is working, then that means there's a greater than average reason for it to go up. So if it's going to go up and it's going up, why wouldn't I just try to day trade the thing that I already know a lot about and is going up and simplify my life? That's what I do. But then there's other things that I just day trade all the time anyway because it's just routine. And what are those? What would we call those? We would call those frog champions, the usual suspects. What are those? EWZ, EWW, so Brazil, Mexico, Cliff Natural Resources, U.S. Steel, Devon Energy, Ethereum, DIA, diamonds, etc. There's a chart that has all that. All right. Next question on risk. How much risk to carry overnight? Does this amount have a reasonable relationship with the gap stat of the particular security? Yes. Yes, it does. Good question. So, if I'm thinking of the swing trade, so now that question is really, what is your swing trade risk? If you're going to hold a position overnight, I just declare by definition that you are in a swing trade. All right. I'm just going to define that mathematically, that if you have intraday risk and you are not carrying it overnight, it's a day trade. If you're carrying it overnight, then you are in a swing trade. So what I find is that 2ATR is 99% of the time greater than the gap stat. So if you have a 2ATR stop, you are already accounting for the size of the above average gap. So if you look back, if you want to refine that, you could look back 30 days or you could look back 200 days, and then you could either pick the average or the max gap percentage on an absolute value basis. The absolute value of the gap percentage, because that tells you how volatile that thing can be overnight. And you may not want just the average. You want to maybe protect yourself against the maximum adverse gap. So when I study the gap stat, if I wanted to refine this, I could say, let me take 1 times the max gap of the last 200 and say, if they gap against me more than that, then that's 1R loss. Or if it was exactly that much and I got out, that would be a minus 1R. So you got to decide which one of those overnight gaps that you can tolerate. My default position is just start with 2ATR. Now, where does that get you in trouble? That's a quiz. Where does the 2ATR overnight get you in trouble? Two ATR trouble. Where? After abnormal quiet. Right? So let's say that you had a swing trade that was 5 days down and you got long and that thing goes up and then it goes into this tiny little So somewhere in here, it might have not just kept going sideways. The ATR, when this goes, you have a small ATR. And so you could actually look at that and say, oh, on the basis of an abnormally small ATR, I'm going to have a large position size. Because for whatever reason, you happen to get into the swing trade when it was abnormally quiet. And so your ATR is abnormally small. So 2 ATR is abnormally small. And yet when there's an adverse news, and it has a big gap down, you have a maximum position size at a moment of maximum gain. So on every swing trade, what I do is I go back and look at the gap stats and I say, what was the max adverse gap in the last 30 days, in the last 200 days, and how does that compare to a 2 ATR? If my 2 ATR is somewhere around there, then I feel like I'm okay. And I'm carrying enough risk overnight to be justified to take the position so that I can make money on it. Otherwise, you're not getting capital employed. But I'm also respectful of these abnormal price shocks against me. So that's how I do that. And that is a personal decision that you got to come up with. How to manage profits in terms of cash flow versus redeployed capital versus powder. Here's how I do it. There's a good video in the stack somewhere about the 4 bullets method. Search until you find it. Briefly, it looks like that. Here's just how I do it. I call them bullets. I have 4 bullets at the start of the day. Why? Because when I was a poor child in Pennsylvania, my dad would give me a .22 rifle and 4 bullets, and he would say, go out and bring home 2 rabbits. And with those 2 rabbits, we could eat dinner and then trade rabbit skins to buy more ammunition. So if I took 4 shots and I didn't hit any rabbits, that was bad. That means out of that bag of ammo that we now had 4 fewer bullets. But if I could bring home 2 rabbits, then we could eat and we could buy ammo. So 2R let me buy ammo and it let me eat. So here's how I manage 4 bullets. So I start the day with 4 bullets ready to go. Each one for me is $400 risk per trade. My span of control is 4. That means I can simultaneously manage 4 positions at once without distraction. But if I get more than 4 on, I start losing my attention, that I start looking at one and I miss something. So 4 is the maximum. What that could be is maybe I see an SSC. And so I put 1 bullet on that SSC. So now I've used 1 bullet. And then on position 2, I see an owl in another symbol. So I decide I'm going to put a bullet on that one. So now I've used 2 of my 4 chips. And I have 2 that are still ready to go. Now, when I take the exit on this one, the first thing I do is I take the money for the bullet and I put it back in the stack. I reconstitute the original bullet. Any excess profits above that, I put into a bowl. So maybe that was 1R. Maybe I gained in. So maybe I had 2R, right? So I got a 2R win. So I made $800. then the first 400 goes back to reconstitute my bullet, and then the second 400 goes into the kitty for 400. Now, maybe this thing is moving along and I say, hey, that SSC is really working. Or no, wait, I exited, right? So I did that. So now I've got 3 bullets and I have 1 that's deployed into the owl. Hey, maybe that owl is really working and I'm able to get a second position on it. So now I fire a bullet. Now I have 2 bullets left and I have a second bullet on this one. Now I've got 2 bullets. If I could get all 4 bullets on that one position, I would have a span of control limit because I can only have 4 bullets, whether that's 1 bullet on 4 positions, 2 bullets on 1 and 1 on 2, or 2 and 2, or I could have 2 with 2 in the kitty ready to go. So that's a span of control of 2. Here's a span of control of 4. 4 bullets, 4 by 1. Here's a 2, 1, and 1, and here's a 2 by 2. In each case, in each of these cases here, I'm already all in. So once I start exiting those positions, I first reconstitute the bullet, and then I put the excess gains in the kitty. Once I make plus 2R, so plus 800 for the day, I take that money off the table and I put that in the bank. Why? Because now that was tomorrow's money. Anything above 800, I can now start creating extra bullets for today. And then on a really good day, I might be able to put more than 4 positions in. I could start doubling up on positions. Why? Because I'm in tune with the market and all my signals are running and I've got momentum and I'm in a good mental state. So that's how I use the idea of 4 bullets to categorize and standardize my risk, how to replenish my ammunition, how to feed the bulldog for tomorrow so I can eat, and then and only then start looking to scale up in the rest of the day. That's how I manage my psychology. Okay? How to execute a trading framework in an IRA without a good faith violation. I don't even know what you mean by a good faith violation. That is my retirement account. I'm operating my account within the rules that are allowed. And if I choose to risk 40% of my retirement on a day trade, that's my decision, nobody else's. That's not a good, there's no implied social contract with anybody on that except my family. And the social contract is I'm going to work my retirement account and they can do with their retirement accounts whatever they want, and I'll teach them how to do it if they're interested. But that IRA is my money and I'll use it the way I want to. And if I decide that a 20-40-40 allocation is my risk tolerance, that's my decision, nobody else's. I don't have any good faith violation issue with some faceless corporate legal agreement, or I don't even know what that means. Well, Ken, that's supposed to be money that you're supposed to. Says who? Who said I'm supposed to do anything? It's not their job to tell me what I'm supposed to do. It's my job to decide what I'm going to do. Oh, the wash sale is different. Oh, that's just a technical reason or a technical rule. If you are cycling money in an IRA and there is a 3-day settlement in your IRA because it's a personal IRA, then you have to account for that. You know, so if you're trading the day trade and now suddenly you exit that money goes into a holding tank for 3 days or 2 days, whatever your clearance, then that money's not available to use until it has cleared that clearing and holding period. So that means you have to have chunks of money that allow you to conduct your trading, to put it into the holding pattern so it can be cleared and be available for trading. So I always have, my brokerage account always says, here's the total value of the IRA. Here's how much is in holding, and here is how much is clear to trade, and that's the amount that I can trade with. So that's not good faith. That's just the 48-hour clearing method. I thought you were talking about some kind of good faith implied social contract to how you're supposed to trade IRAs. I've heard that before. Sorry, misunderstood. Olaf gave Zoran a link to a TradingView script that allows for a PSAR to be calculated off of the RL10. I'm also going to promote my buddies Jeff and Sonal over at R Factory. They've been studying .io. They've been that's Jeff and Sonal. I trust them. They've been working with me for 10 years. They're full-time traders of currencies, futures, options, ETFs, all time frames in the UK. And he is a trading coding wizard. He and Danny are both my little programming wizards. Jeff's kind of specializes in TradeStation and TradingView, and he puts together beautiful platforms. In fact, the little dashboards that you see done in TradingView and TradeStation from that Bill Scheit has been using, that Jeff occasionally shows, are coming from Jeff's work, and he's very reasonably priced. In fact, he's built a couple robots for TradeStation that auto trade some of my patterns, and they're starting a little subscription service, and that looks pretty interesting. And then Danny is just a flat out wizard who has done the TC 2000 bundle, which is a thing of beauty, and which is going to go up in price once we get out of COVID. And he also has done the options course, which is magnificent. His options course, he's selling it for $3,000. I told him he's nuts. I said you should be selling that for $10,000 to money managers. What he's done is taken all of our tortoise trading patterns, systems, principles, and strategies, and developed an 11-lesson course that shows you how to use options exactly in that way with copious numbers of case studies. And kid's a genius. He just posted one on the way he has been trading SPCE. That's that Virgin Galactic. Beautiful swing trader. He's had 4 lather, rinse, repeat swing trades from highs to lows and lows to highs. It's just well done. Yeah, Lynn says he found Jeff last week. The TV screen is much cleaner. Okay. Oh yeah. And Zoran says Schwab calls it good faith. Okay, that's just the the clearing, so that they're not carrying your risk as money is cleared through their clearing firm. Okay. So anyway, that's what I would say on that. And then Garen, I think I answered your question in there. Chi Wang says, if I have an SSC triggered on 2 highly correlated symbols, you'll often see it exactly those two. You'll see like X and CLF are firing on the same pattern, and then they're both members of XLB. And you would actually see XLB all firing. The SSC pattern that's working is the same pattern on all of those. So instead of chasing your tail on 3, I just take the first one. First come, first serve, because if it's U.S. Steel, that might be the one that's leading the way. So I just go first, and then I crush the one that is working first. I watch the other ones because I've got a span of control of 4. If that's a little bit delayed and is also starting to work and I can get a really tight stop on it, that might be the easy one. I can get a really low-risk trade on Cliff, because if it works, the Cliff buyers are going to come in. So I'll pick the first one first, but watch the others. It would not surprise me to get all 4 of my span of controls onto X and CLF in some kind of sequence where I'm putting 1, then 2, then 3, then 4, and then get rid of that one and put the 4th one on and then get all out and reconstitute my 4 bullets and then just keep recycling bullets. That would be that wouldn't be unusual. But sometimes on those intradays, you can actually catch the timing and hit the sweet spot on most of them. Because if X starts first and then starts to peter out, but Cliff started later, that might still be working while U.S. Steel is stalling. So you might just scratch and then ride the dragon. So I do like to take first things first and then adapt and respond to there. Okay? Lynn says, when I trade the SSC and related patterns, I see that the follow-through after entry varies from either like a quick stop or a 2R greater return. And he has heard me comment, I hear you comment often that with an SSC, the odds are that the deeper and harsher the winter, the more potential for a stronger move back to normal. That is true. Are there other characteristics related to the pattern likely to improve the odds? I think so. And I'm not going to try. I'm getting a little tired right now, and we've been into this for a while. So I would just say, let me generate a list generically, the first ones that come to mind, and then there may be some more that come to our mind. Okay. So I would say probably. Harsh winter. So the harsher the winter, the faster it pulled away from the Bollinger Band main, the better. I would say the RLFF analysis. So like if you saw a big difference, there's two parts of that. There's it's either very tight, where the RL270 and the RL10 are identical, or very wide, where there's a long distance between the RL10 and the RL270. So that gives you an idea of the magnitude of the move. It could be range stat analysis. I'm going to so let me talk about that one in a second. Range stat. What else? Let's see. Time of day after a large gap, in conjunction with a swing pattern. So after a large gap, then the chance of this being a large range day is bigger. Time of day, if it's early in the day and there's still room to run to a range stat for either side, then in either direction, then that's good. Also in the last half hour, the chance that it moves back to the VWAP is large, so you got to take that into account. If there's a swing pattern already going with you in the direction of that move, then it's amazing. Also, if we're close to a high of the day or low of the day breakout, so that if that move is also going to cross yesterday's high of the day or low of the day, that could add an extra burst. Also, a 10-day high-low, or an X-day high-low. So that's why you see me looking at the 2, 10, 30, 90, and 270 level breakouts, because every one of those could be adding extra burst to that pattern, right? There could be a sector sympathy. So if the sector is already moving violently in your direction, then that could be something. And also market sympathy. So any of those things, they tend to be extra, either pieces of news or part of your nightly trade frame. I would also, let me add just the time sympathy or frame, or the time sympathy frame. So like when we do the when you'll see tonight, Ken Hum does the weekly, daily, hourly frames. Sometimes you will see some synergy. You'll see some synergy in those, right? So weekly, daily, hourly frames. Those could all be part of it. So all of those things taken together are going to improve your odds. And if you can stack them up, and even like multiple patterns, so like if you started with an SSC and then it became an owl, and then you got a Kata 2, and then you got a second Kata 2, and then a third one, that might be a Kata 2 on a large time frame. And you could be into a runaway move. So all of those things can lead you to extremely large moves. But it starts off, to me, with that harsh winter. So let me talk about the range stat analysis next, okay? So in the range stat analysis, let me know if that works for you, Lynn. Are you in tonight? Yeah. So let me know if any of those were not clear. So on the range stat analysis, oops. So here's the start of the day, and here's where it opened. The way we define the range stat is the maximum reasonable intraday move. So at the open, it's already the maximum move it can make is a plus range stat or a minus range stat in either direction. So right from the opening, then there is then you have the maximum opportunity to get that large move, right? Now, if you've already seen the second part of this range stat analysis, if I'm like here and then it's like this, and I'm getting a Kata 2, I have less of an opportunity of a huge move to the upside because I'm still kind of capped at this statistical measure. So I really only have this move reasonably left compared to at the start of the day, I had that much of a move. So all other things being equal, I'd like to go earlier in the day. But conversely, if this thing moved a range stat all the way down, it's already an extraordinary day. And then if it starts to move, I've already seen that this thing is in play. It's already had the maximum move. Now, if it just is going to go back to something like the fair value here, now because it's moved so far in this direction, which gave me a harsh winter also, now this move is big. So if this range stat move was also a harsh winter move, then that makes this a double plus yummy move. And then it could get back to the VWAP and then go the same distance to the far side. That's not unusual. Now, the RLFF analysis means that if the RL270 and the RL10 are really tightly compressed and this thing starts to move, then I can just go estimate how far is the average move of the RL10 away from the RL270. By the same token, if this thing has already moved a distance down and now is starting to reverse back up on a swing trade, I can measure that in terms of, hey, there is 1, 2, 3, 4, 5. There's 5 ATR just back to the RL270. So that would give me some estimate of the size of that move. This might have been a harsh winter and a 5 ATR move on the basis of the RLFF analysis, and so that makes it a priority. So the more of these things stack in my favor, more is better. So part of your integrated trade frame analysis is how you can do that. But I really like this one. If there's a swing pattern on a day or a weekly, and it's a intraday pattern as well, I like both of those because you're going to get some swing pattern buyers and sellers along with the day trading buyers and sellers, and that extra energy taken together can produce large moves. Okay. All right. That's everything I got. It's at 7:30. We're at 90 minutes. That's a good day's work. Half an hour. We will start the swing review, and Ken H put a bunch of things in there. Hopefully you got some value out of this one. I thought there was some good coverage. We'll get this posted, and then off we'll go. Okay. Take good care. We'll see you in a half an hour, some of you, and others tomorrow for the day trade. Take good care.